You placed the stop for a reason, not randomly, not arbitrarily. You identified the level where the trade idea would be invalidated, where the structure that justified the entry would no longer exist, where the market would have told you clearly this thesis is wrong. You placed the stop there. You defined the risk. You accepted it before entry. You told yourself, if price reaches this level, I exit. No negotiation, no hesitation. Out. Then, price started moving against you, slowly at first, then with more conviction, and the stop that was defined, accepted, and committed to before the trade began suddenly looked different, too close, too tight, placed slightly wrong, in need of just a little more room. So you moved it. Not because the trade improved, not because the market structure changed in a way that genuinely warranted reassessment, not because new information arrived that altered the thesis. You moved it because the loss was approaching, and the loss felt unacceptable, and the stop, the structure that existed to protect you, became the obstacle between you and the emotional comfort of not yet being wrong. So you removed it, and the trade that was supposed to cost you 1% cost you 3 or 5, or the kind of number that does not appear in your risk parameters because the risk parameters assumed you would honor the stop you set. This is not a story about bad discipline. It is a story about a specific neurological event that occurs every time real capital approaches a defined loss point. And understanding that event, precisely, clinically, without judgment, is what separates traders who honor their stops from traders who keep moving them. In this video, we're going to examine exactly why stop-loss movement happens, what is driving it at the neurological level, and what the structural shift looks like that makes honoring stops as automatic as placing them. Let's go deep. Part 1. The purpose of a stop-loss. A stop-loss exists for one reason: invalidation. It marks the specific price level at which the trade idea, the thesis, the structure, the analysis that justified the entry is no longer valid. That is its entire function. Not punishment for a bad trade, not an arbitrary risk parameter imposed by a trading rule. The structural definition of where the market has told you that you were wrong. Before the trade is entered, in the calm, rational, prefrontal cortex dominant state of pre-entry analysis, this function is clear. The stop is placed below the support level because if price breaks below that support, the bullish thesis is invalidated. The stop is placed above the resistance because if price breaks above it, the bearish setup no longer holds. The stop is the answer to one specific question: at what price does the market prove this trade wrong? And the answer to that question is structural. It is derived from the chart, from the price action, from the logic of the setup, not from how much the trader is willing to lose, not from a percentage of the account, from where the idea fails. This distinction is critical because a stop placed at the invalidation point is a stop that has a structural reason to exist, and a stop that has a structural reason to exist has no legitimate structural reason to be moved, unless the market structure itself changes in a way that genuinely alters the invalidation point, which is rare, and which is never the reason stops get moved. The reason stops get moved is emotional, and the first step towards stopping the movement is understanding exactly what emotion is driving it. Part 2. The neuroscience. What happens when the stop is approached? Let's go inside the brain, because the experience of watching price approach your stop-loss is not a neutral analytical event. It is a threat response. And understanding the neuroscience of that response explains why the decision to move the stop, which is objectively irrational, feels completely rational in the moment it is made. When price moves toward the stop loss, the brain's threat detection system activates. The amygdala fires, cortisol enters the bloodstream, the nervous system shifts into a state of heightened vigilance. This is the same mechanism activated by physical threat. The brain does not distinguish between the threat of financial loss and the threat of physical harm. Both activate the same ancient survival response, and that response has a specific objective: avoid the threatening outcome. In a physical threat context, avoidance means moving away from danger. In a trading context, avoidance means preventing the stop from being hit, which means moving it. The decision to move the stop is not an analytical decision dressed in emotional clothes. It is a pure threat avoidance response. The brain is doing exactly what it was designed to do, generating behavior that moves the organism away from a threatening outcome. There's also a second neurological layer specific to stop-loss movement: anticipated loss aversion. The psychological pain of a loss is approximately twice as powerful as the pleasure of an equivalent gain. But anticipated loss aversion is the experience of that pain before the loss has actually occurred. As price approaches the stop, the brain begins simulating the experience of the loss being realized. It runs a preview: the account balance decreasing, the position closing at a loss, the emotional experience of having been wrong. And that simulation, that neurological preview of the pain, activates the loss aversion response before the loss has happened, creating urgency to prevent it, which manifests as the decision to move the stop. Not because moving the stop improves the trade, because moving the stop delays the simulation becoming reality. The brain is not trying to improve the trade, it is trying to avoid the pain, and the stop is the obstacle between the current state and the pain. So, the stop is moved.
Part 3. Negotiating with reality. The moment price approaches the stop, the internal negotiation begins. It is immediate, automatic, and almost always disguised as analysis. The negotiation sounds something like this: maybe it just needs more room. This looks like liquidity sweep below the level. Smart money is hunting stops before the reversal. The structure on the higher time frame is still intact. One more candle and it will confirm the bounce. Each of these thoughts sounds analytical. Each uses the language of market structure and technical analysis. Each presents itself as a legitimate reason to reassess the stop placement. But examine them honestly. Were any of these considerations present before the trade was entered? Was the possibility of a liquidity sweep analyzed before entry? Was the higher time frame structure assessed and found to be overriding the entry time frame stop level? Were any of these genuine analytical factors, or did they appear specifically at the moment price approached the stop? The answer in almost all cases of stop movement is the latter. These thoughts did not arise from new market information. They arose from the threat response seeking justification, from the amygdala generating narrative that the prefrontal cortex can accept as a reason to act. Because the amygdala knows that naked emotional avoidance, moving the stop simply because losing feels bad, will be rejected by the rational mind. So it dresses the avoidance and analysis. It finds the technical reason, the structural argument, the narrative that makes moving the stop look like sophisticated market reading rather than fear management. And the prefrontal cortex, under cortisol influence, accepts the narrative because it wants to, because the alternative, honoring the stop and accepting the loss, activates the anticipated pain the entire system is trying to avoid. This is negotiating with reality, and reality, unlike a trading stop, does not move for emotional convenience. Part 4. The fear of being wrong. Moving a stop loss is rarely about analysis. At its root, it is about identity, specifically about the identity threat of being wrong. When a trade moves against you and approaches the stop, the impending exit carries a specific psychological weight, not just the financial weight of the loss, the identity weight of the verdict. The market is about to deliver a judgment that the analysis was incorrect, that the entry was poorly timed, that the thesis did not hold. And for traders whose identity is connected to correctness, whose self-concept includes being a skilled analyst who reads markets accurately, that judgment is a personal threat. Closing the trade at the stop does not just realize a financial loss, it confirms a verdict about competence, and that confirmation is often more painful than the monetary cost. So the stop is moved, not to improve the trade, to delay the verdict, to keep the position open, to keep the possibility of being right still alive for as long as possible, even as the financial cost escalates, even as the risk expands beyond the original parameters, even as the loss that was supposed to be 1% becomes 2, then 3, then whatever the pain threshold is that finally forces the exit that happens not at the invalidation level, but at the emotional breaking point, where the accumulated pain finally exceeds the pain of admitting the original thesis was wrong. This is the true cost of connecting identity to trade outcomes, not just the psychological instability, the financial escalation that identity protection produces. Every moved stop is an investment in the identity's refusal to be wrong, and every moved stop converts a defined risk into an undefined one.
Part 5. The escalation pattern. One moved stop creates the conditions for another. This is the mechanic most traders do not examine clearly. The first stop movement creates temporary relief. The immediate threat of the loss is postponed. The identity verdict subsides briefly. But price continues moving because the market is indifferent to the emotional state of the trader. It does not stop when the stop is moved. It continues moving based on the forces of supply and demand. And the new stop level, placed further from the entry, is approached. Now the decision must be made again. Honor the new stop or move it again. And the second movement is easier than the first because the neurological threshold for stop movement has been lowered. The behavior has been repeated once. The pattern has been established. The brain knows that moving the stop is available as a response to the threat of loss. So the second movement requires less resistance to execute, and the third less than the second, until the trader is managing a position that has consumed 2, 3, 5 times the original risk, with a stop that has been placed so far from the entry that the distance back to break even requires a significant reversal, that the original thesis, whatever it was, is long since irrelevant, and the trade is being held not from structure, from the sunk cost, from the inability to accept the accumulated loss that the sequence of stop movements has produced. This is how controlled losses become catastrophic ones, not from a single decision, from a sequence, each step small, each step feeling temporarily justified, the total damage enormous. Part 6. The psychological relief trap. Moving the stop creates psychological relief. This is the mechanism that makes the behavior so persistent. In the immediate term, moving the stop works. The approaching loss is postponed. The cortisol response reduces. The emotional pressure lessens. The trade is still alive, and for a brief period, the trader feels better. That feeling is the trap, because the brain learns from it. It learns that moving the stop produces relief, and it associates relief with the behavior of moving the stop, which makes the behavior more likely the next time the stop is approached. This is operant conditioning. The behavior of moving the stop is reinforced by the reward of temporary relief, and reinforced behaviors become habits, which is why traders who move stops once almost always move them again. Not from lack of awareness, from neurological conditioning. The short-term relief of the moved stop is more neurologically immediate and powerful than the long-term benefit of the honored stop, and the brain's decision-making system is heavily weighted toward immediate rewards over delayed ones, which means the structural solution to stop movement is not willpower applied in the moment, it is the removal of the choice from the moment entirely, through pre-commitment mechanisms that make the stop non-negotiable before the threat response activates.
Part 7. Lessons from Professional Traders. One principle shared consistently among experienced traders regarding stop-loss management is this: the stop is placed by the best version of you. Honor the best version of you. Before entry in the calm, analytical, prefrontal cortex dominant state, the stop was placed at the structural invalidation point. That placement represented clear thinking, objective analysis, the genuine assessment of where the trade idea fails. The trader who moves the stop under pressure is not demonstrating superior market reading. They are demonstrating that their compromised state has overridden their clear state. The correct response to that situation is not to follow the compromised state. It is to execute the decision that was made in the clear state. The stop was placed correctly. Honor it. Another principle observed among professionals who have maintained consistent risk management across extended trading careers: a controlled loss is an asset, an uncontrolled loss is a liability. A controlled loss, taken at the defined invalidation point, costs 1 unit of planned risk. It preserves capital for the next trade. It maintains the statistical foundation that allows the edge to function. An uncontrolled loss, the product of moved stops and emotional management, costs an undefined and often much larger amount. The professional chooses the controlled loss, not because it feels better, because it is mathematically and strategically superior every time. Part 8. Practical Tools for Honoring Stops. Let's get concrete. The first tool is the stop placement documentation. Before every trade, write down 3 things: the stop level, the structural reason for that level, specifically what market condition would have to exist for that level to be reached that would invalidate the thesis, and the commitment statement. If price reaches this level, the trade closes. No exceptions, no adjustments. The idea has failed. This documentation transforms the stop from a price level into a structural commitment, and commitments made explicitly with documented reasoning are harder to violate than undocumented ones. The second tool is the stop movement test. When the urge to move the stop appears, apply a single test before any action. Has the market structure that defined the original invalidation level genuinely changed? Not, has price moved closer to the stop? Has the structure changed? A new structural development that legitimately alters where the thesis fails passes the test. The urge to move the stop that cannot pass this test is emotional avoidance, and emotional avoidance is actioned by honoring the stop, not by moving it. The third tool is the automatic stop order. Place the stop as an actual order in the platform, not as a mental note, not as a level you will watch and exit manually, an order that executes automatically if price reaches the level. This tool removes the decision from the moment of maximum emotional pressure. The stop executes not because the trader chose to honor it under pressure, but because the mechanism is in place that requires no choice in the moment. The fourth tool is the post-movement audit. After any session in which a stop was moved, conduct a specific review. What was the original stop level and structural reason? At what level was the stop moved? What was the internal justification for the movement? Was that justification structural or emotional? What was the ultimate outcome of the trade versus the outcome at the original stop? This audit builds a personal record of the cost of stop movement in specific dollar amounts across real trades. That evidence, accumulated over weeks and months, is the most powerful argument for stop adherence that exists, because it is not theoretical. It is your account, showing you precisely what stop movement costs every time.
Closing. The stop was not placed to hurt you. It was placed to protect you, to define the point at which the market has clearly told you that the thesis was wrong. And the moment you begin negotiating with that definition, the moment the stop becomes something to work around rather than something to honor, risk stops being controlled. And uncontrolled risk in a probabilistic environment produces outcomes that the original risk management was designed to prevent. The 1% loss that the stop would have produced becomes the 3% loss that the moved stop created, and the 3% loss that the second moved stop created, and the 5% loss that the final capitulation produced. Not from one decision, from a sequence of small emotional decisions that each felt temporarily justified, and each compounded the damage of the one before it. Document the stop. Apply the structural test. Use the automatic order. Run the post-movement audit, and honor the decision you made in the clear state, before the threat response arrived, before the cortisol compromised the evaluation, before the identity protection mechanism generated the narrative that made moving the stop feel like analysis. That version of you, the one who placed the stop correctly before the trade, knew exactly where the idea failed. Trust that version every time. Your growth as a trader begins with self-awareness. The rest follows. I'll see you in the next video.